In this video, we'll answer what is value investing. While some say value investing is for dinosaurs, a relic of a previous investment age, is that characterization fair? At the end of the day, all investors are typically seeking the same thing: better returns. However, because investing in personal finance is behavioral, the methodology can be as important as the returns themselves. In this video, we'll answer what is value investing. We'll start by covering the story of Mr. Market, defining value investing, reviewing approaches to valuation and characteristics of value investors, answering why stocks deviate from their intrinsic value, recognizing risks such as the value trap, noting a logical fallacy when people discuss the evidence on value investing, and covering the different types of value investors, purists and modernists. If this is your first time on this channel, welcome. My name is Matthew Sanchez. I'm a certified financial planner and certified exit planning advisor. I'm a financial professional, so as you can expect, check the show notes for disclaimers. Now let's dive in. Value investing can best be exemplified by the parable of Mr. Market, which is found in The Intelligent Investor. That's that book there. Imagine for a moment that you recently bought a home for $350,000. While you're unpacking and just getting settled into your house, you hear a knock at the door. You open the door and you see your neighbor. He introduces himself as Mr. Market and he welcomes you to the neighborhood. He tells you that he just absolutely loves analyzing his property value. And since your property is identical to his, the same size, square footage, same model, same condition, and the same upgrades, for all intents and purposes, it's a perfect substitute. He enjoys valuation so much that he would be happy to share that information with you. Because you bought your house for $350,000, he believes both houses are worth $350,000. About a week later, you hear another knock at the door. You open it up, and you're surprised to see Mr. Market again. What can I help you with? He replied, well, I just got done doing another analysis of our home values. I analyzed the data from our street, our neighborhood, our city, our county, our state, the country, the world, and based on all these factors, based on every factor I can analyze, I believe our houses are actually worth a little bit more than when you bought a week ago. In fact, now I believe they're worth $360,000. He then asks, would you like to buy my home? Or are you interested in selling yours? Like most people, you might say, that's really interesting information, but I'm okay for now. Thanks. Another week goes by, and like clockwork, another knock at the door. It's your neighbor again, but you can tell he seems a little frazzled. What's up, Mr. Market? He replies, well, I just got done doing another analysis, and I made a big mistake. After looking at the data from our street, our city, our state, our country, the world, it turns out that our houses have actually gone down in value to the tune of $25,000. So instead of being worth $360,000, they're actually worth $335,000. Would you be open to selling yours, or would you like to buy mine? Probably a little surprised that he would offer, given what he just told you. Again, you thank him for his time and go back to living your life. Now, a pattern starts to develop. Every week, there's a knock at the door. And every week, you'll find Mr. Market is happy to provide you with his belief of what your homes are worth. And at the end of every analysis, he always seems willing to give you an opportunity to buy his home or see if you're interested in selling yours. Over time, you notice that there are times when Mr. Market is just overjoyed and thrilled with what's going on in the world. And sometimes his valuations get a little ridiculous. In one case, he thought your house was worth $400,000. Then, the following week, he got carried away in optimism and thought it was worth $500,000. Other times, you can see his pessimism is getting the best of him. In fact, there are times when he quotes the house as being worth $300,000. And again, gets carried away a week later and is just wanting to get out and sell his house, asking as little as $200,000 for it. Warren Buffett sums up Mr. Market's behavior by saying he's kind of a drunken psycho. Some of these days, he gets very enthused, and on some days, he gets very depressed. And when he gets really enthused, you sell to him. And if he gets depressed, you buy from him. Just like you wouldn't be willing to sell your house just because someone quoted you a low price for it, or someone's high quote isn't going to induce you to buy theirs, for a value investor, it's the same concept applied to stock. You wouldn't let others' opinions affect your strategy, would you? Would you sell your home or a company just because someone else thought it was worth less? If this story helped you better understand value investing, let me know with a like and subscribe. So what is value investing? It's an investment philosophy characterized by a focus on buying companies or their shares below intrinsic value. Let's break that down. Number one, it's an investment philosophy. Other examples of investment philosophies include growth investing, momentum investing, or socially responsible investing. Number two, it's focused on buying companies. That is, equity ownership, typically on the stock market. However, this could include the practice of buying companies in the private equity markets as well. Number three, below its intrinsic value. Before you can buy something below the intrinsic value, you must first determine what that intrinsic value is. Value investors are going to employ fundamental analysis to determine what they believe the intrinsic value is. If you'd like to make a career in it, consider getting a CFA or Chartered Financial Analyst designation. Overall, there are three main approaches to determining value: the income approach, the market approach, and the asset approach. Let's break those down. Within the income approach, there are two different methods. There is the discount cash flow method, which is a methodology that takes into account future cash flows, is effectively based on the belief that the past numbers are not reflective of the future growth. The other method is a capitalized earnings method, and this is typically where historical cash flows are going to be used. The next approach is the market approach. The market approach also has two main types: the public guideline method as well as the guideline transaction method. Public companies are going to use the public company guideline method, and the guideline transaction method will primarily be used in the private equity markets. The last approach is the asset approach, which can also be broken down into several parts. There is reported book value, adjusted book value, and premise of value. The premise of value can be broken down into a couple of different ways. Primarily, there's continued use, value in place, orderly disposition, and forced liquidation. In addition to using one or more of the combined valuation approaches, other common metrics for value investors will be price to earnings ratios, price to sales, enterprise value to EBITDA, which is earnings before interest, depreciation, taxes, and amortization. During fundamental analysis, it's likely that the data will be scrubbed and oftentimes adjusted for one-off impairments or for exceptional earning items. It's important to note that these metrics in and of themselves are pretty useless without context. And that context can be the company itself on a historical basis, as well as its competitors and what it's doing within that industry. Even with that context, analysts are going to want to determine why the value is displaced and why, again, it will change in the future. So How did value investing begin? Benjamin Graham, the godfather of value investing, said, "Investing isn't about beating others at their game. It's about controlling yourself at your own game." Some argue he would have been the greatest investor of all time had it not been for his protege, Warren Buffett. Graham's book, The Intelligent Investor, was published in 1949. It is considered by many value investors to be the investing Bible. While he never actually used the term value investing in it, the features of the investments he describes are what are now known as value stocks. There are several updated additions to this book, which go into great detail and provide many examples of this philosophy in action. The core message is always the same. And again, as you can see, I have a copy here on my shelf. I'll include a link in the description if you're interested in getting one too. There are three main characteristics of value investors. Number one, they focus on a stock's intrinsic value. They want to own companies that have sound principles and sound financials. As Warren Buffett says, price is what you pay. Value is what you get. Another characteristic is that they don't believe in the efficient market hypothesis, which states that stock prices already reflect all the information about the company into account. Many value investors believe that the market may be short-term efficient, but it's long-term inefficient. The third characteristic of value investors is that they are often contrarian. To get uncommon results, you'll have to risk looking different than the common indices. When everyone else is buying, they're often selling or standing back. When everyone else is selling, they're often buying or holding. As Baron Rothschild allegedly said, "It's time to buy when there's blood in the streets, even if it's your own." Value investors shy away from trendy stocks, and this is where much criticism comes from. However, many value investors are willing to miss on the upside of growth companies. However, they will often take a second look at stocks that are household names when those stock prices have plummeted, believing those companies can recover from those setbacks if their fundamentals remain strong and the products and services still have quality. By buying stocks below their intrinsic value, this creates a margin of safety, a risk management technique, if you will. And the investor profits when the stock price eventually corrects itself and returns to fair value. Why do stock prices deviate from true value? Well, stock prices can deviate from their true value because it may be trading on a psychological basis rather than on market fundamentals. For example, if an investor sees a stock going up, they may decide that they want to buy in based on FOMO. Conversely, when a stock price is falling or the overall market is declining, loss aversion compels them to sell their stocks. So instead of keeping their losses as paper losses and waiting for the market to change direction, they accept and confirm their losses by selling. Another reason why stock values may deviate from intrinsic value would be due to market crashes. When the market reaches an unbelievable high, it usually results in a bubble. And when the bubble bursts, investors end up panicking, which further exacerbates the sell-off. This isn't anything new. We've seen this several times throughout history, whether it's the tech bubble bursting in the early 2000s or the market crash in 2007, 2008. Another reason stocks deviate from their value is because they are often either unnoticed or unglamorous, and oftentimes the news headlines are going to talk about the next great technology and tech startups instead of boring established manufacturers. Another reason would be due to good news or bad news. Even good companies face setbacks such as litigation or maybe a recall. And just because a company experiences a negative news event doesn't mean that the company is not fundamentally attractive. Analysts overall don't have a great track record of predicting the future. And yet, oftentimes, investors often panic when a company announces earnings that are lower than the analyst's expectations. Value investors tend to see beyond the downgrades and the negative news headlines, which allows them to buy stocks at a deeper discount. And being patient, hold it until it is brought up to its long-term value and thereby profit. The last one we'll talk about is cyclicality. Cyclicality is defined by fluctuations that affect the business. Companies are not immune to the ups and downs of the economic cycle, seasonality, or quarterly trends. This can affect the price value of a stock, but this may not necessarily affect the company's long-term value. Remember, all investments have their risks and benefits. A common misapplication of value investing is that investors are simply investing in failing companies just because they're cheap. Oftentimes, this leads to the value trap or trying to catch a falling knife. A value trap happens when an investment that has been trading at low levels presents itself as a buying opportunity for investors. This can be misleading if no material improvements are made to the company's competitive stance, to its ability to innovate, to its ability to contain costs, and or for its executive management to perform. Without such catalysts, the stock price could fall further until the company is in an existential crisis. Warren Buffett has expanded the definition of value investing by saying that it's a focus on finding an outstanding company at a sensible price rather than a generic company at a bargain price. Remember, price is only one component of the analysis. While other investment philosophies may fall victim to being priced to perfection, or they may completely disregard fundamental analysis altogether, these philosophies tend to fuel price bubbles because they do not have a valuation filter to stop buying if the company is overvalued. When the bubble eventually pops, investors tend to rush back towards quality investments and oftentimes value stocks. Does this in any way guarantee results? No. Value stocks can get caught up in a market sell-off too. However, when the market does recover, investors typically start with solid companies and solid fundamentals. When you see growth versus value debates online, oftentimes you're going to find the glaring fallacy of division. This refers to an attribution placed onto an entire class, that is, assuming that each part has the same property characteristics as the whole. This in turn creates a sea of bad data, and a common example is when people talk about the historical performance of value indices. Remember, value indices are typically based on value factors, such as low PE ratios, but this isn't necessarily how a value investor would choose stocks. A commonly cited piece of evidence for value investing is the Fama-French three-factor model. Historically speaking, this model shows that value outperforms growth investing by an average of 4%. However, this is not without some criticism. Some claim that value investing is dead, pointing out that growth beat value in 10 of the last 15 years. There are other criticisms of this research. However, what I'd like to get back to is that division of fallacy, and that value investors tend to be very selective of the companies in their portfolio, which may deviate from the performance of indices. So the debate continues. Are we in a new trend, or will the law of large numbers bring performance back to historical averages? There are a few different types of value investors. The spectrum is from purists on one end and modernists on the other. While both groups focus on fundamental analysis, purists may focus more heavily on financials, energy, healthcare, and traditional value plays, and avoid technology altogether. Modernists, on the other hand, are more focused on the process of value investing, looking for quality companies at a good price. While they would like to avoid the most expensive technology stocks, they may be attracted to a technology company that trades at a good price. This is also known as GARP, growth at a reasonable price. We just broke down value investing and discussing the story of Mr. Market, what value investing is, approaches to valuation, characteristics of value investors, why stocks deviate from their intrinsic value, risks such as the value trap, a logical fallacy that people make when discussing the evidence on value investing, and the different types of value investors, purists and modernists. I'm curious, what kind of investment philosophy do you follow? What other kinds of videos would you like to see? Let me know in the comments below.